you are. I'm guessing we've got a few here, or I can see we've got a few here in from the US, a few here from the UK. So wherever you're dialing in from, whether it's morning or whether it's afternoon, I hope you guys are doing pretty well. So today, just a few things before we kick off. I just want to ask everyone that if anyone's got any questions, please feel free to just put your hand up at any time. Now, I know for a number of you that you'll be at various stages of the fundraising journey. And so today we're speaking quite generically, but also quite insightfully, I hope, around what is the latest insights, behavior, trends, etc., that we're seeing in the startup and specifically the impact, sustainability, climate tech space. And what is it, therefore, that founders really ought to be thinking about and really ought to be aware of during this time? If you've got any questions at any point in this, please don't hesitate to drop it into the chat. I can see those popping up in front of me. And equally, you can get in touch with me either on LinkedIn or send me an email at jake@jakewilmwellpovey.com. And my mission here is to share with you those insights and to help you. So I would really value you getting in touch. I'm inviting everyone to sign up for a strategy call to understand how I can help you right now during what I believe is going to be a bit of a fundraising downturn. So if you've got any questions, please jump on one of those calls and we can work out how we can support you through that. So my intention for this session today and what I'm trying to achieve with all of you is share with you some insights on the state of climate tech and impact fundraising today as it pertains to high growth tech-based startups. Then the second thing we're going to undertake here, or my intention to share with you today, is how to navigate what we believe is going to be a bit of a downturn. And then thirdly, how to fundraise in a downturn. Now, I've used that word there, intention, quite purposefully, because it could sound throughout this like there's plenty of doom and gloom going on. And that is not my intention either. The facts, the stats, I should say, might show a slightly pessimistic picture. There might be negatives in there, etc. But that is just a little dose of realism. And the reason I want to share this presentation today is because I believe there's absolutely a way through what we're facing today. And most importantly, because of what you guys do as impact startups, it is critical, not just for money making, right? Which is obviously why most investors get into this and a large reason why a large number of founders create their businesses. But it's important, it is critical for the health of society, the planet, the environment, biodiversity, etc., that you guys are successful, and investors know that. So we're building here startups, we're building the next generation, okay, of change makers, so that by taking 2050 as a proxy, for example, the world is a better place than it is today. So the message for this today is that I believe you guys can and will navigate this downturn, and I believe investors want to back you, but it's about navigating those waters as we sit here today. And so really what we're here to talk about for this first section is the state of the market today. Now, I imagine we've all seen little tidbits and we've seen snippets of information, but what we want to talk about here is the state of the market as it pertains to startups, and specifically startups who are trying to raise money. Now, I'm going to go into all of these in a little bit more detail. The fact that funding markets are a little bit tighter, we're seeing slightly lower valuations. And because of that, because there's slightly less money and it's more expensive, there's more competition for investment. What that means is that any individual investor, whether it's an angel, whether it's a venture capitalist, they're seeing more deals. They're taking longer to appraise them, and they're giving them more scrutiny. And we'll come on to share loads of stats on this. Don't worry, I'm not inviting you all in here and just throwing up a couple of obvious Hail Marys here. But what that does mean, and one of the things I'm going to implore you to take away from you, is the need to focus on fundamentals. And what I mean by that is, regardless of what stage you're at in your startup, it's important to be able to demonstrate and build the fundamentals. Like, what are those one or two key KPIs? Maybe it's a finance related one like revenue. Maybe it's a customer orientated one like acquisition of customers, subscribers, pilot performance, etc., and potentially an impact related KPI. What are those couple of key pillars that really help to demonstrate our story? And bearing in mind what I've just said about scrutiny, what that story needs to demonstrate is one that delivers much more profitable growth. And what I'm saying there is, gone are the heady days of kind of 2021 or 2019 when investors were just throwing money at startups and saying, listen, just grow at whatever cost. And because capital was easy then, startups knew they could spend whatever it took to grow because it didn't really cost them much. Capital was cheap. Today, capital is much more expensive. Valuations are lower. Investors have got much tighter terms that they're giving their money out on. So if it's more expensive, what that really means for us is that we need to focus on growing in a profitable way, or focus on growth that leads to profitability. That's what investors are going to reward. And that's what we're going to need to demonstrate if we want to grow our companies in a way that works for us as founders from a dilution point of view. Now, bringing all this together, the fact that we're in a bit of a downturn, cash is tighter, growth is likely to be lower. What that really means is that optionality here, as a function of the fact we've got cash, is sovereign. We used to say cash is king. Absolutely it is. But it's not only is cash king or sovereign here, but also we need to have optionality. And I'm going to share a little bit more about that later on when I talk about how do we navigate this, what do we do to get through it. So let's dig into where we are right now. And this is a little screenshot of a pretty widely shared VC tweet that essentially compared where we were in 2021 to where we are in 2022. And the summary here is, guys, take our money in 2021 versus in 2022. Guys, I don't know what you think we said to you, but actually we need to just take another look at this. We need to slow down and we need to focus on investing in fundamentals. I don't think this is going to come as a surprise to many of you, but I thought this was quite a comical way, especially coming straight from one of the VCs who are showing their irony, to demonstrate what that means. And really, it all started in public markets, and really from Thanksgiving. And you can kind of see here, let me see if I can get my snazzy little pen out. Here we go. We can kind of see here in around Thanksgiving time in the US, suddenly markets realized there were some geopolitical strains going on. Inflation was too high because supply chains post-COVID were unraveling too slowly. There were supply chain bottlenecks, and so much money had been pumped out into the system by governments through either quantitative easing or stimulus, etc., during COVID, that demand simply outpaced supply, creating all these inflationary pressures, therefore uncertainty around interest rates. And so what you can see here, especially if you look at fintechs, their valuations here have dropped from kind of 25 times forward revenue multiples, i.e. in a year we think we're going to be earning 10 million, so we'll be valued at 25 times that, 250 million pounds as a company. They've dropped basically almost a third. And now fintech companies, you can see them all the way down here, right, as of about a month ago, they're valued at just 5 times. So what would have been 250 million off a 10 million valuation, 10 million pounds worth of revenue in a year's time, has now dropped all the way down to a 50 million pound valuation. So that's an 80% drop in valuation. And I'm picking there on the most extreme, but you can see what's happened there. And to anyone who isn't as familiar with later stage investing or venture capital investing and how that works, this is important because when an investor invests in you today at, say, a share price of £1, they're critically aware of what they think they're going to exit at. Are they going to exit at £5 a share or £10 or £100? Now, if public market valuations have dropped, like they have here, 80% for fintech companies, then let's say they thought they were going to exit at £100 a share and make 100x return. Now, an 80% drop means they think they're going to exit at £20 a share. That's much less appealing. I mean, still 20x on that example is great, but just bear with me on that. And I hope that makes sense, but just let me know if it doesn't, and I can certainly explain that in a bit more detail. But essentially, people's exits are looking less valuable. And that means when people enter investments, when they invest to start with, they're being much more scrupulous about what they invest in. And we're expecting to see this continue. Now, a little footnote here is that public markets are very much what we'd call leading indicators, i.e. they look to the future about what's going to happen. And you compare that to interest rates, which are typically lagging indicators, i.e. interest rates will always try and catch up with historic inflationary data. And so really, because public markets here kicked off around November time, around what was likely to happen in the future, that also means they're more likely to recover quickly. So even if interest rates stay high for a long period of time, or inflation stays high for a long period of time, don't expect funding markets to always be in that sort of dire straits. We might expect, say, 6 months prior to any of those kind of nadirs, that public markets would have priced in all of those future scenarios. Investors will then be more comfortable and they will say, actually, I think there's a recovery coming. Now's a great time to invest. Stock markets, stock prices should rise, and as a result, funding should then return. So whatever you think, whatever you read about what's up and coming in terms of is a recession on the way, etc., that recession itself won't map what happens with stock markets, and therefore won't map what happens with venture markets. So that was a real whistle-stop tour there. I hope that will make sense. Please just raise your hand if it doesn't, or get in touch with me, or just drop your name in the chat, or get in touch with me on the chat privately, and we can pick this up afterwards. But this is all important backstory. So let me just take my little pen off. So what does this mean as we stand here today? Well, this slightly confusing chart, what I'm trying to share here is, does this treat all parts of the venture space equally? And the answer is no. And the two things I'm going to show here, just to highlight this point, is what is happening here in angel investments around the 5 million mark, and what's happening here around VC around the 10 million mark, compared to what's happening up here, okay, in the bigger ticket space. What we're showing here is that actually it's the later stage, bigger investments that are more impacted in terms of investor scrutiny, valuation, competition, etc., compared to the smaller, say, $5 million or pounds angel investments. They are still relatively untouched. Now, I say relatively because, I mean, I don't want to give any exceptions here. Any generalizations, you guys approach each of these, and if there are exceptions to the rule, then great. But don't be surprised if any angel investors are saying to you, oh, actually, guys, I want to change the valuation terms, or I want to change the terms I'm investing in because of all of this big public market stuff. It's an easy excuse for them. And if you are them, why not? You know, use that pressure to negotiate a better deal. But just understand, this is the sort of market we're in. Later stage companies, more scrutiny. Earlier stage companies, slightly more fluid, slightly more buffering going on there. So just bear that in mind. And again, this is all really important context. So what does this mean for startups then? So all of these charts I'm going to show in the following slides, these are all from a Sifted, which is a startup online magazine. This is all from a Sifted survey. And what this shows from their latest June reader survey is that 48% of startups have less than 12 months runway. And that's a problem, because what we're seeing is more investor scrutiny for investments. So if you're going to new investors, you're likely to face more scrutiny. And equally, if you're going to existing investors, they are also going to be much harder to please, much harder to get approval from for more cash. And what's worrying there is, with all of these companies saying they've got less than 12 months, and what we mean by that is we're adding together, obviously, the people here, 15% have got less than 6 months, 33% have got between 6 and 12. That gives us this beautiful 48 figure here. Those companies are likely to be under stress to raise a lot of money. And this is a bit unfair in many ways, because so many startups operate with, they go round to round on 12-month cycles. So it's not unexpected that we have so many companies in this space. But when we look at the investor appetites that we're facing, the investor environment, it does mean it might be challenging. And so my message here is that we need to start thinking about cash and fundraising sooner. And this goes back to my earlier point about we need to give ourselves options. If we know it's going to be harder to raise, we know we might not have as much runway as we want, now is the time to focus on options. And we're going to talk about that in a little bit more detail later. So moving on. So what are these startups seeing? Well, 72% of startups are taking steps in light of this to increase their runway. What that means is drawing down on potential borrowing facilities, cutting costs, and we'll show you some more evidence on that, but also approaching investors to try and do bridge rounds, try and tap investors at lower valuations, just so they can get that cash in the business and weather whatever storm may or may not be coming up. 83% of startups are finding it harder to raise than they were, say, 6 months ago. And again, that's not surprising because all that data I've shared and all the anecdotal data is that investors are being much more scrupulous with their investments. They're taking much more time to consider deals. And what that also means is that investors are showing much more pressure. 41% of investors, or at least startups, are saying 41% of us are feeling pressure from investors to demonstrate a path to profitability. And I think the reason for that is because they're saying, well, we can give you some cash now, but how do we know you're not going to need more? What if this slowdown takes longer, lasts longer? We need to make sure that if we're investing today, there is a path here to profitability. And this isn't just going to be a black hole of cash that we're going to keep funding you into and into and into. And that is going back to my point earlier about focusing on the fundamentals. How can you build the pillars of this business so you can build a great story that demonstrates how you're generating both financial returns and profitability, i.e. sustainability, and you're delivering impact returns that these investors want you to see. So what is that investor feedback? And what does this mean for you guys as startups? Well, they're being more cautious. They're saying no to more things. There is less fear of missing out, and there is more fear of getting burned. And so what this means for you is you should get more coverage with investors. Approach more of them. Now is the time to reach out, kiss more frogs, look underneath more and more stones. Do whatever you can to increase that coverage, because the chances are that you're going to get more no's. They're going to take longer to say yes. If they do say yes, you're likely to get less money because investors are going to be more conservative, and you're probably going to get a lower valuation. So try and cover more investors, not only to make sure we get funded, but also we need more competitive tension in rounds if valuations are generally dropping. So get more investors at the table and try and improve or hold on to valuations that way. Due diligence is also reported to be taking longer and it's going to be more extensive. That's because investors are making sure they're not getting burnt. Just to give you a little bit of context on that point, what that means is really, if you think about it from an investor's point of view, whether you're an angel investor, you'll be thinking, why the hell did I make that investment right now? You know, the chips were down, the economy wasn't looking great. This really is the time for me to just sit back, see what my options are before I take steps to improve and increase my personal wealth, which is how they think. And from a venture capitalist point of view, they're going to have their own investors who fund those funds that they operate. And those investors are going to say to them, you need to demonstrate why these are great investments in this current environment. And so VCs that go and make frivolous, hopeful investments that aren't backed by rigorous kind of data, traction, KPIs, etc., are going to look pretty foolish, and they're going to have egg on their face when they have to talk to their own VCs about why they've done the investments that they've made over this period. And so bringing this back to due diligence, make sure you're more prepared. Make sure you've got your data rooms ready to go, make sure your data rooms are covering everything, and make sure you've got the data that surrounds the business performance, the key KPIs, acquisition costs. If it's a deep tech company you're working in, make sure you've got the technical data there so that there are no excuses why this investment round is going to take longer than it should. Because these deals are taking longer, any individual investor, again, whether it's an angel or whether it's a VC, is going to have more deals on its docket, so to speak, than they would have done before. They're going to take more time to look at them. And in that noise, it's more important than ever that you stand out from the crowd. And there's a few ways to do that, but the critical thing here is to really focus in terms of your materials on your USP. What makes you guys absolutely unique? Why are you guys uniquely placed to win? And how do you demonstrate the defensibility of your operation, your venture here? Now, if you want to talk about how we can present that, then please don't hesitate to get in touch and, in fact, book into one of those strategy calls at the end of this, and we can talk about how we demonstrate and articulate that defensibility. And then the final two pieces are kind of tied here. We're going to see tighter term sheets, i.e. they're going to be more terms that are more investor friendly, more protections. They're going to want more visibility, more information, more voting rights, etc. And the valuations are going to be down. So just manage that in your expectations, but remember that survival is better than valuation. Holding on to that amazing valuation when you've got no cash in the bank is not only going to lead to a probable demise when you run out of cash, but also means that valuation is just going to crumble when you then go begging to investors for a last minute injection of cash. So survival here is much more important than valuation. But there's a flip side to this. Okay, and this is part of the symptom, but it's also part of the cure. And I'm going to come on to this later when we talk about optionality and playing to win. We're seeing from this reader survey, a number of startups are cutting back on spending, 6% on hiring, over 50% cutting back on marketing and sales, 30% or 35%, so over a third of startups are either laying off today or they're expecting to lay off staff. And over 60%, even if they're not laying off, are dialing back or freezing hiring. That in turn is making it very much an employer's market. Gone are the kind of days from 6 months ago, post-pandemic, when everyone was coming back to work and people could command whatever salaries they wanted, what terms they wanted. Am I working from home? Am I not? Now it's very much an employer's market, a buyer's market. Okay, so there is some positives in that in a way. Startups are very much, there's more talent available because there are fewer people looking. So if you are able to reposition yourself, or if there are any critical hires, now is a great time to make them. But the other thing, just reading in between the lines there that I put at the bottom, is investors are lowering their growth expectations because they can see how hard it is to grow right now. They know there is a lot of pressure on burn, discretionary expenditure. A lot of them are lowering those expectations. I wouldn't be surprised if the vast majority of us are in that camp of lowering our own expectations and forecasts. But for those of you who are in a great position, or those of you who can raise or have just raised, now is a great time to actually put your head above the parapet and demonstrate here that you can outperform. So it's not all doom and gloom here. One person's slowdown is another person's opportunity to overtake, and we'll dig into that in a little bit more detail later on.